In the financial world, you might think you're investing, but in reality, you're just playing a game whose rules have been written by hidden hands. Companies issue bonds not for growth, but to drain capital. Stock prices don't rise due to real success, but because of the hands of market makers. Technical analysis won't help you win in the end. It just reassures you as you walk into the trap. The entire market is a stage. You're given a map drawn with candlestick patterns and support zones. However, no one tells you that the road leads straight to your wallet. Are you ready to step in? Do you still think you're a free player? Welcome to Truths in the Lies, where you will hear the truths society doesn't want you to know. The essence of companies issuing bonds in a market economy. When we talk about bond issuance, it's commonly assumed that it's a sign of a business growing and needing capital to expand. But in reality, behind this shiny exterior are calculated financial moves, sometimes even shady. To truly understand the essence of corporate bond issuance, we must peel away the media gloss and see a clearer, more honest picture. A company is essentially a profit-generating machine. When there's a new investment opportunity or the need for cash to expand, the company turns to borrowing. Initially, that might be from banks. With collateral like factories, machinery, and land, they can secure significant loans. But banks don't lend indefinitely. Assets are limited, while the capital needs are infinite. And when loan opportunities are blocked due to lack of collateral, companies start looking to the financial market for funding. That's when they turn to stocks and bonds. Stocks are a way to raise funds by selling a share of the company's ownership. Bonds, on the other hand, are simply debt instruments where the company promises to repay the capital plus interest in the future. In theory, bonds are safer than stocks because even if the company loses money, it still has to pay its debt. But this belief has made it easy for many investors to be manipulated. When a company chooses to issue bonds, it must create a very attractive image. And to achieve this, it cannot do without the help of market makers. Market makers are individuals who manipulate the market. They help companies inflate stock prices, creating the illusion of a successful business. Financial news fills with positive reports. Profits are up, big projects underway, strategic partners lined up, all to build trust. When stock prices peak, the company issues bonds. At this point, investors, already convinced by the rising stock prices, are easily persuaded to buy the bonds. They believe that if the stock price is rising, the company is doing well and the risk is low. Many companies even use their own stock as collateral for the bonds. It's a promise that even if there's risk, you still hold the company's stock. But that's a trap. Once the bonds are issued, the market makers begin to withdraw and stock prices begin to drop. The promises are left behind. Investors hold nothing but a pile of debt securities while the company begins to cry wolf cash flow stalls, and they might not even be able to pay interest. They'll start giving excuses: market volatility, delayed projects, rising costs. But in reality, the company has used bond money to refinance debt, plug holes, or even embezzle for personal purposes. In other words, bond issuance no longer serves as a legitimate fundraising tool, but has turned into a method for raising money from retail investors to keep a struggling company alive. It's a game of trust, and the losers are often those who invest last. So, what is the real purpose behind bond issuance? There are three main reasons. First, borrowing money to expand the business. Second, borrowing money to make financial investments. And third, borrowing money to cover internal financial crises. The first is the healthiest, but it's quite rare. The second carries risks because poor financial investments won't generate cash flow to repay debts. The third is the most dangerous, where companies use new money to pay off old debt. And when there are no more investors willing to invest, the whole system collapses like a Ponzi scheme. The truth that few want to admit is that whether bonds or stocks, they are essentially the same debt. Stocks are short-term debt You invest, but whether you make a profit or loss, the risk is yours. Bonds are long-term debt. You lend money, but if the borrower doesn't pay, you can't do much except file a lawsuit. With a fragile ability to recover capital, the global corporate bond market has seen several speculative bubbles. From large real estate companies to anonymous financial firms, everyone's jumping in to issue bonds. Interest rates soar, promises are everywhere. But then, a wave of companies defaults. Investors who trusted the safety of bonds backed by collateral watched their assets evaporate, because it turns out the collateral was just land without proper legal backing or stock prices plummeting. The lesson here is not just caution, but understanding the essence of the game. When a company issues bonds, ask yourself, why can't they borrow from a bank? Because if they were strong enough and transparent enough, the bank would lend to them. Only when there's no other option do they turn to you, the retail investor, as a lifeline. And you need to understand that you're buying nothing but a debt instrument. And when the cash flow stops, the spiral begins. So bond issuance in many cases is simply a way for companies to transfer risk from themselves to you. In conclusion, corporate bond issuance is a useful financial tool when used properly and transparently. However, when abused, it becomes a game of betting on trust. And in this game, only those who understand the essence have a chance of surviving. Everyone else is just prey in the new debt-based game, where companies get to dream and investors pay with real money. The invisible hand doesn't come from the market, it comes from the manipulators. The story begins in what seems harmless. A company needs money. When they still have collateral, they go to a bank. But banks aren't fools. After a few rounds of assessment, when there's nothing left to pledge, the bank will refuse. And that's when the company turns to the stock market, where they don't need to promise profit, just create an illusion of potential. First, they need their stocks to look attractive. The price must rise, the news must be good, the chart must look nice, and they hire market makers. These market makers don't care about how the company performs. They just need to manipulate the chart to fit the pattern the crowd loves, breaking previous peaks, crossing the MA 200, breaking through resistance, and green candlesticks with long bodies. Then, the media gets involved, and financial reports filled with praise growth is steady, plans to expand, strategic partners lined up, all designed to build trust. Retail investors begin to take notice, and this is when technical analysis plays its role as a psychological bait. The players open the charts and see all the technical signals confirming what they believe. Here's an uptrend, here's a consolidation zone, and there's a resistance level that's been broken. Everything looks logical, and they start buying. The price continues to rise. Confidence is solidified. Investors feel they are investing based on knowledge, but in reality, they are simply acting in exactly the way the market makers intend. When the stock price reaches a high enough point, the company begins issuing bonds. They claim they need capital to expand factories, develop products, or acquire other companies. Investors see the stock price rising and believe that the bonds are a safe opportunity. They promise high interest rates, with the collateral being the rising stock. There's even an issuance guarantee and independent auditing firms verifying the financial reports. All of this builds trust. This is portrayed as a surefire profit opportunity. But what is that trust built on? A chart drawn by hand, from technical patterns that aren't natural but intentional, from a financial education system designed not to help you win, but to make you step into the game with hopes of winning. From an overwhelming number of technical analysis courses, from instructors who teach candlestick patterns without actually living off trading. Think about it. If 100 people learn the same technical analysis method, draw the same charts, who wins? No one. Because the ones really making money are the market makers, not those guessing which way the market will go. Technical analysis is just a prop. The script has already been written from the start. After accumulating enough money from bonds, the company starts letting go. The market makers pull out, stock prices start to fall, and the chart begins to reverse. Technical patterns no longer serve their purpose. Investors panic, stocks fall sharply, taking down the value of the collateral for the bonds. The company reports losses. Cash flow turns negative. Interest payments are delayed, and repayment ability is postponed. Eventually, the company declares bankruptcy. Investors lose both their stocks and bonds and are left with a hard lesson. But the game doesn't stop there. When a series of companies go bankrupt and the market enters a panic, new players begin to wake up. They bitterly realize that beautiful charts don't reflect the health of a company. Technical analysis only helps to legitimize their own trust. Every time you draw a trend line, set a Fibonacci, or mark a support zone, you're setting the trap for yourself. And then you ask, why are there still thousands of people learning technical analysis? Because it's a money-making ecosystem built on illusions. 1,000 technical analysis teachers thrive because there are 1 million people learning. These 1 million learners are the fuel for market makers, the lifeblood for companies to paint dreams, the foundation for bonds to become legal money-sucking instruments. In a game where everyone has access to the same data charts, news, reports, the advantage doesn't lie in who knows more, but in who controls the crowd's belief. The market makers don't care what analysis method you use. They just need you to believe enough to go all in so they can lock in their profits. The invisible hand of the market doesn't come from macroeconomic principles. It comes from those powerful enough to control capital, cash flow, and emotions. When you see the price break through the MA 200 and plan to make a move, they've already set up the distribution zone. And when you're convinced that bonds have collateral, they already have a debt deferral request in hand. So if you truly want to survive in this market, stop thinking like a deer. Don't just look at the charts to predict the direction. Look up at the sky and ask yourself, where is the tiger lurking? And how hungry is it? Think like the market makers. Ask yourself, if you were them, what would you need the players to think and do so you could make money? When you think like this, you won't be caught off guard by pullbacks, false breakouts, or patterns that seem real but are fake. The essence of technical analysis isn't wrong. What's wrong is how it's abused to legitimize financial dramas. The problem lies in how people treat technical analysis as if it were a religion, believing in it as truth, forgetting that prices don't move because of patterns, they move because of cash flow. And cash flow always has a purpose. You can't control the price, but you can control your own belief to prevent being misled by a crowd as blind as you are. Stocks, bonds, technical analysis, all are tools. But when the tools are in the hands of manipulators, the game is no longer fair. If you don't realize this, you will always be the last one in, where all the numbers look perfect, all the charts confirm the trend, but the price is about to turn. So my final advice from someone who has shed blood many times in the market, don't trust what you see, don't trust what you measure, trust what you understand. And to understand, you must peel away all the technical layers, all the analysis tools to see the game playing behind the curtain. Only then will you truly be an investor, not someone being invested in by their own trust. The essence of technical analysis and the manipulation game. Many young traders have spent hours reading hundreds of technical analysis books, following investment channels from Facebook, Telegram, to YouTube, from candlestick patterns to Bollinger Bands, RSI, MACD. Learning to draw trend lines like they're creating artwork. Learning to measure Elliott waves like they're measuring ocean waves. Yet after all this, many leave the market with massive debts after brutal bloodbaths. Not because they weren't skilled enough, but because they didn't understand the true essence of the game they were playing. People say that the financial market is a test of patience, knowledge, and emotions. But few mention that it's also a stage where the knowledge you've learned is sometimes just a prop for a pre-scripted drama. And you, with all your analytical efforts, are just an audience member bringing real money into the gambling arena controlled by those pulling the strings. Let's be honest. If everyone learns the same knowledge, if everyone reads the same charts and uses the same technical indicators, then who wins and who pays you? The answer is the winner isn't you, because those teaching you how to read charts are the ones designing the game. They don't need to win every trade. They need you to participate, to bet, to believe you have the tools to win. But in reality, all you have is a sense of control. While the real script is written behind the scenes, I don't deny the value of technical analysis. It's a useful tool. However, when the tool becomes big, the story is no longer academic. Look around. Financial books are everywhere in libraries. Trading classes are sprouting up like mushrooms after rain. YouTube videos teach you to draw patterns in every style. They teach you how to draw, how to measure, how to predict. But no one teaches you the most important thing: who creates that candlestick? Prices don't rise or fall by themselves. They move because of cash flow, and that cash doesn't come from you. It comes from big funds, from market makers, from sharks who can swallow the entire market. You analyze price as if you're measuring the speed of a marble, but it's in the midst of a storm. And they are the ones stirring the storm. You're trying to guess where it's going, but they are the ones who decide. They need you to analyze, because the more you believe in the model, the more you trust in the strong support zones, the easier it is for you to go all in. You draw a resistance line and they break it. You see a breakout signal and they trigger a false breakout. You notice an uptrend and they start distributing. All of this is just to do one thing: lead you into the market with confidence and take your money when you let your guard down. You think you're trading smartly, but in reality, you're just reacting according to the script. When the price moves as you analyze, you think you're right. When it moves against you, you blame it on market psychology. But the truth is, everything you see has been designed for you to act as the manipulator desires. It's like a shell game. If you're the player, you're guessing based on probability. But if you're the operator, you might already know the result beforehand. And the market is the same. When you learn technical analysis, you're in the position of the player. But when you understand how the price board is designed, you become the one controlling the game. The financial market is a place where data is public, but strategies are secret. Everyone has the same charts in hand. However, not everyone has the ability to read the money flow, because data is just the surface. The real action is beneath the surface, where large capital pools its resources. They leave no clear traces, but they leave false signals. They show you repetition, so you believe in patterns. But those patterns only exist until they decide to break them. I've witnessed many people losing their accounts right at what's called strong resistance zones. It's not because they were wrong, but because they believed too strongly that they were right. Believing that the market would respect the analysis, but the market doesn't respect anyone. It only serves the strongest, those who can control it. So why are there so many people teaching technical analysis? Because it's the bait for thousands of teachers who profit from technical analysis, because there are 1 million people learning. Those 1 million learners are the fuel that powers the market. They are the lifeblood for those behind the scenes pulling the strings. They need you to believe in a method so you have a reason to invest. And when you invest, you become a pawn in the financial power game. Imagine this. In a herd of deer being hunted, you don't need to run faster than the tiger. You only need to run faster than the other deer. In the financial market, it's the same. You don't need to be the smartest. You just need to make fewer mistakes than others. But to do that, you need to stop thinking like the crowd. Stop believing in widely popular ideas, because anything that's free is the product. And when you learn technical analysis for free, you might actually be the product being traded. If you truly want to survive, learn to think like a market maker. Ask yourself what they want to do, what they need to take from the retail players. When do they buy? How do they distribute? Don't just look at the price chart. Observe behavior. Don't just count the ticks, measure the market psychology. When you understand that the market is unfair, then you know how to defend yourself. When you realize you're playing a game that's controlled, you won't be shocked when you lose, and you won't be overly excited when you win. There's a saying I strongly believe in: sharks don't fight in the village pond. True power doesn't need to argue online, doesn't need live streams to flaunt knowledge. They silently gather assets, distribute in the dark, and leave you with blurry indicators. When you buy, they sell. When you're scared, they buy back. This cycle keeps repeating, and if you don't change your mindset, you'll be the one spun around like a pawn. The market doesn't teach you how to win, it teaches you how to lose the least. Technical analysis doesn't help you beat the market, but it gives you a reason to make a trade. That's the truth. And only those who have blown their accounts many times can truly grasp it. I'm not saying all this to make you give up. On the contrary, I want you to stay alert, learn technical analysis, but don't idolize it. Use it as a tool, not as a religion. And most importantly, remember that you're playing a game where the rules are never written clearly. Whoever understands this will be the one to survive. If you enjoyed today's podcast, please like, share, and subscribe to my YouTube channel. There's a lot more content coming your way that could benefit you.